Hi, I'm Dan Danford. We're doing a series of podcasts called Money Made Easy for DadsDivorce.com. A great question came to us from a viewer this week, and a very common one that we hear today. What closing costs should I anticipate in purchasing a home? Really good question, and now is a great time to buy a home, actually. Housing prices are depressed quite a little bit after the last couple of years, and interest rates are at their lowest level in decades. A fixed rate mortgage typically is in the 4s today. Really, you have to roll back the clock some 40, 50 years to hit a time when borrowing money was so cheap, and that's really important. Now, the thing about closing costs, and like I said, one of the things about buying a house is that it's probably the largest and most complicated purchase that you'll ever make in your life. And many of the people around you, the realtors, the bankers, the insurance people, all those folks, they do it all the time, and you do it fairly infrequently. So I just urge caution when people are buying homes. It's just an area where they have a lot of expertise and you don't have much. So you have to have people you really trust when you're walking through this process, okay? Now, closing costs are kind of a mystery, and when you actually get ready to buy your house, they have to present you with an itemized list of closing costs, and that includes all of the upfront money that's necessary in order to buy this house. Unfortunately, even though they've made it simpler in recent years, it's still fairly complicated to understand. So let me just walk through a couple of things. One thing is that almost always you'll have to have an appraisal of the property. In other words, the bank isn't going to lend you $100,000 to buy a house without somebody going out and looking at the house and determining that it is worth that much money. That just protects the bank if you default. Similarly, they'll want a title insurance policy, okay? Now that's kind of complicated, but what it used to be is that anytime you bought a piece of property, somebody would do an abstract on that property. In other words, they'd trace back for as long as there are records to find out who owned that property in the past, and every time it changed hands, did things change hands properly so that none of those people could come back now and make a claim against you and say, hey, I know you bought that property, but it's really mine, okay? It's a complicated process that people used to use. Now what you do is you buy an insurance policy, and basically an insurance company someplace issues a policy that says if somebody does come back and make a claim, that they will stand behind you. And again, the bank is going to require that, okay? That's the way the bank protects themselves, okay? Another thing is that when you close on a house, in almost all cases, it's partway through the year, okay? So partway through the year, that piece of property has taxes already owed at the end of the year. So if you close in April, say, well, January, February, and March already went by, so those part of taxes are owed, by the person who owned the property before you, while you'll own the rest of the taxes. So there'll be a chunk of your closing costs that is actually a prorated part of the taxes. In other words, the person who sold you the property, they have to pay you for 3 months worth of taxes so that when December rolls around, you'll be paying the proper amount and they will have paid their portion of it. And the last big chunk that you're going to see, or one of the last big chunks, is insurance. Today, most mortgagors provide an escrow account where you pay insurance on the property. That's their way of assuring that the property is insured. They can make sure that if the house burns down, there's an insurance policy in place because they're going to make you pay that all the time. So, again, they're going to find out how much a year's worth of insurance is, and they're going to put that into an escrow account, and it's going to be part of the closing. And then one more thing that you see some today is what they call points, and those are loan origination fees. So if you're going to borrow $100,000 from the bank, they may say, well, we'll loan you the money at 4.25% if you pay some money in advance, or we'll loan it to you at 4.5% or 4.75% if you don't. And sometimes it may make sense to pay those points. You don't see them quite so often today in a competitive environment because everybody's just offering mortgage rates at their lowest rate. So when you combine all those different things, when you go to sit down and sign over your papers on your house, okay, you're going to owe a chunk of money at that time. Those are called closing costs. Now, it's important to remember a couple of those, like your prepaid taxes and prepaid insurance, and maybe even your title insurance, are actually expenses that you would incur anyway. You're just paying them up front. So they aren't like, it's not like money that's thrown away. It's money that goes to your credit for the future. Now, to answer your question, there's a great lending site I suggest people to check out online. It's called bankrate.com. Okay? And bankrate.com has all kinds of great information on interest rates. So like if you're getting ready to buy a mortgage or something, you can find out how competitive your lender is by going and comparing. One of the things they have is they have a little map of the United States that shows you the average closing costs in each state in the union. So here in St. Louis, I went on to the bankrate.com site and I looked up a $200,000 home in Missouri last year had closing costs just shy of $2,400. Okay? Now they'll have similar numbers for each state in the union, and that's important because there are a couple of things that are different. A home in Chicago or a home in New York City probably has much higher taxes than a home in a rural area. So their closing costs will be higher because you're having to pay that chunk of taxes. The same thing's true of insurance on your property. Some places are higher insurance rates than others. So even though we can kind of make some general rules, it really pays to go to some place like that and look it up. And like I said, in the state of Missouri, last year it was about 1.25% of the amount of the mortgage that you take out. So if this is real easy to research, you can look into it yourself. Those are kind of some general rules that we use in issuing mortgages and what to look for when we help our clients. I hope it's helpful for you, and good luck in buying your home. That's it for this week of Money Made Easy. We'll see you next week.